So the S&P is trading up near all-time highs, right around 7,400.
Mm.
And I mean, if you just glance at the headline indices, everything looks, incredibly calm.
Oh, yeah, totally humming along perfectly on the surface.
Right, exactly. The machinery seems fine. But if you actually look under the hood today, there is a violent rotation happening.
Yeah.
I mean, we are seeing a 5% overnight plunge in South Korea's KOSPI index.
Which is massive.
It's huge. And we're tracking these massive, just aggressive pullbacks across the entire semiconductor space, wiping out literally trillions in market cap in a matter of weeks. So, welcome to the deep dive. Today, we are looking at a diagnostic landscape that is, frankly, completely fractured.
Yeah, it's the absolute definition of diagnostic muddy waters. I mean, the surface metrics are completely masking the underlying turbulence right now.
And that is exactly our mission for today. We have this massive stack of institutional research, technical trading videos, macro strategy notes, and we are hunting for actionable trading levels.
Right, because the opportunities are there.
Exactly. We're dissecting these severe price action anomalies, and most importantly for you listening, we're tracking exactly where this smart money is secretly repositioning.
Yeah.
Because while retail investors are, staring at the major averages, institutional capital is executing this massive structural shift.
Yeah.
So, okay, let's unpack this. What is the fundamental mechanism driving this massive shift underneath that calm surface?
Well, we really have to look at unusual volume and price action anomalies from a trading perspective to find that answer. And it basically boils down to this concept called the source of funds.
Okay, source of funds.
Yeah. So institutional capital is currently rotating out of the absolute giants of the market, specifically, the mega cap tech stocks, the MACD 7. They're basically treating these heavily weighted index leaders as an ATM.
Wow, just cashing out.
Exactly. They are liquidating those positions to move capital into heavily underloved equity factors that just offer much more attractive forward valuations.
And the data on that equal-weighted divergence is honestly stunning. Like, our sources highlight that through the first 2 quarters of the year, if you strip away the market cap weighting, right, and look at the MEG Z7 on an equal-weighted basis, they were actually down 1.7%.
Yep. Down almost 2%.
So while the major indices were, printing all-time highs on the evening news, the average mega cap tech stock was actually bleeding capital.
Right, because the institutions are actively booking gains on those recent winners to finance a move into what the institutional research is calling the AR7.
The AR7, right?
Yeah. These are the companies physically building the backbone of the artificial intelligence revolution. So we're talking about power generation, physical memory, data center cooling. And through those same first 2 quarters, an equal-weighted basket of this AR7 was up over 75%.
I mean, going from a nearly 2% loss in the headline darlings to a 75% gain in the infrastructure players, that is just a staggering divergence.
It's massive.
It really tells you exactly where the smart money is placing its bets for the next decade. So smart money is basically using the MACD 7 like a massive ATM to fund their next big bets.
That's exactly it. And if we connect this to the bigger picture, it paints a very clear narrative. I mean, the AI trade isn't dead, and it's not bursting, it's maturing.
Okay.
The smart money is moving away from the initial picks and shuttles phase.
Yeah.
The company's just designing the chips, and it's flowing directly into the foundational gritty infrastructure required to actually turn those chips on and keep them running without, melting down the local power grid.
Right, which brings us to the mechanics of a few of these AIR7 companies.
Yeah.
Because you have Vertiv Holdings, which deals with the incredibly complex liquid cooling systems that these massive data centers need.
Yeah, because the thermal dynamics of modern AI chips are fundamentally changing data center architecture. I mean, you cannot run thousands of highly advanced GPUs without industrial-scale liquid cooling. It makes a company like Vertiv literally a non-negotiable bottleneck in the AI supply chain.
And then you have Taiwan Semiconductor, which is heavily onshoring production, right? Massive new facilities in Phoenix to secure the domestic supply chain. And crucially, you have American Electric Power.
Oh, the power demands are insane.
Completely astronomical. American Electric Power is up over 20% year to date, but because it's a utility, it still offers a dividend yield of over 2.5%.
Right, which is highly attractive to that institutional capital. And this perfectly explains the severe price action anomalies we're seeing in the chip designers themselves.
Because the capital is rotating out.
Exactly. But this is where the trading perspective gets really interesting. Because institutional capital isn't abandoning semiconductors forever. They are just waiting for very specific entry points.
Okay, so let's move from that macro rotation to precise, actionable technical levels on the charts. because we need to look at where the algorithms and the pension funds are, actually programmed to buy.
We definitely have to start with the heavyweights. I mean, since its highs on May 14th, NVIDIA has lost $1 trillion in market cap.
It's wild to see out loud.
I know, right? Both NVIDIA and Broadcom have basically been in free fall, but they are now sitting directly at their daily 200 simple moving average.
And to put that in perspective for you listening, $1 trillion wiped out in a matter of weeks. But when you look at the fundamental valuations in the research, this pullback has completely reset the math. NVIDIA is now trading at roughly 18 to 22 times forward earnings.
Which is incredibly low for them.
Right. That is the cheapest it has been since 2019. That's long before the generative AI boom even started. It's literally trading cheaper than the broader S&P 500 and the NASDAQ U100 on a forward earnings basis.
And the institutional models note that if NVIDIA's forward multiple dips below 20, it triggers these automatic accumulation algorithms for massive funds. They basically view it as a screaming buy. And we are seeing that exact smart money positioning physically materialize on the charts. Like, look at the semiconductor ETF, the SMH. It pulled back 15 to 16% from its highs, but the moment it hit the $550 to $560 demand zone, which, by the way, perfectly aligns with its daily 50 simple moving average, it bounced aggressively on massive institutional volume.
But the research really zeroes in on the memory sector for the most actionable trading levels, doesn't it? Because the processing power of an AI chip is completely bottlenecked if it doesn't have the memory bandwidth to feed it data.
Oh, absolutely. The DRAM ETF itself is down 31% from its $55 highs.
Right, and Micron is sort of the perfect case study here. It pulled back 28%, dropping from highs over $125 down to the $88 level.
Yeah.
And that $88 level is not arbitrary.
No, not at all.
It is the daily 50 SMA. But beyond the technicals, the fundamental catalyst at that level is this massive 10-year supply deal Micron just signed with Global Wafers.
Yeah, that deal completely changes their long-term margin predictability. It secures their silicon supply chain for a decade, which completely insulates them from overseas geopolitical shocks. And we're seeing similar technical bounces at heavy volume nodes across the entire sector.
Like SanDisk, right?
Yep, SanDisk is bouncing off the $1,500 psychological and technical level. Marvell suffered a 32% pullback, but found violent buying pressure the exact moment it completed a technical gap fill at the $218 to $225 zone. And AMD is just fiercely defending the $500 to $505 demand zone. TSM is holding $420.
Okay, wait. We're basically catching falling knives at these moving averages, right?
Yeah.
I mean, how does a trader know this 200 SMA is a trampoline and not just a trapdoor leading to a much deeper systemic correction?
That's a totally fair question. And the technical research emphasizes that, yes, short-term volatility at these levels is basically guaranteed. However, the mechanics of algorithmic trading and pension fund mandates mean that purchasing historically dominant companies at these major long-term historical demand zones, it offers an incredibly asymmetric risk-reward profile.
Yeah.
Because they just don't get that cheap very often.
Exactly. You don't get opportunities to buy Broadcom at the daily 200 SMA very often. The sheer volume of smart money stepping in at these exact inflection points suggests institutions view this as a generational accumulation zone.
Right. Well, I want to pivot to the macro risks now, because we know where the smart money is executing their technical trades, but we have to look at what the fundamental bears are seeing.
Yeah.
Because there is this massive looming shadow over the entire sector regarding a $1.2 trillion AI capex shock.
Yeah, the scale of the spending is creating an aggregate demand shock of just historic proportions. I mean, the hyperscalers, the massive cloud providers like Amazon, Google, Microsoft, they're projected to spend $800 billion on AI capital expenditures just this year alone.
$800 billion.
Yes, that represents 2.5% of the entire U.S. GDP, and the projections show that by 2027, that number will hit $1.2 trillion, or roughly 3.5% of GDP.
And the bear case here, which is heavily championed by analysts like Ed Zitron in our research stack, points out a glaring structural flaw in this spending spree. These hyperscalers currently have no real pathway to profitability on that specific AI spend.
None at all.
Right, they're building the infrastructure at a breakneck pace. They're buying $40,000 chips by the tens of thousands. But the end user demands, the software subscriptions and enterprise deployments required to actually justify trillions in servers, it just isn't showing up on the balance sheets yet.
Yeah, the real risk is that we are building the world's most expensive railroad without knowing if anyone actually wants to buy a ticket to ride it. And that leads to a highly controversial concept circulating in the institutional research right now, the new too big to fail.
Oh, right. Senior ETF analyst Eric Balchunas proposed a fascinating theory on this. Because retail participation in equity ETFs is so massive now, meaning almost every American's 401k is essentially a highly concentrated bet on these specific tech giants, the U.S. equity market itself might have reached a point where it is just too big to fail.
Yeah, the institutional research notes are actively floating the idea that if this AI capex bubble bursts and we enter a severe cascading bear market, the Federal Reserve might actually be forced to step in and buy equity ETFs directly.
Buy
But
equities directly.
yes, to prevent a total catastrophic collapse of household wealth.
That is just a staggering evolution of moral hazard. I mean, wait, in 2008, we bailed out automakers to protect real, tangible jobs on the assembly line, right? We bailed out banks because the literal plumbing of the global credit system froze. Are we really talking about the government potentially subsidizing server farms that don't make money yet, just to keep index funds from crashing?
Well, if CEOs and institutional investors fundamentally believe there is an ultimate government backstop for equity markets, it completely distorts all risk incentives. It explains exactly why smart money is willing to buy the dip on NVIDIA at the 200 SMA. I mean, if you believe the Fed will ultimately guarantee your downside to protect the broader market, risk management just becomes secondary to aggressive accumulation.
And, according to the institutional notes we're reviewing, there's also speculation that the current administration's focus on electability and maintaining positive market sentiment could theoretically influence the likelihood of these kinds of extreme Fed interventions.
Right, the political pressure factor.
Exactly. The political pressure to avoid short-term economic pain ahead of major election cycles adds this massive layer of complexity.
Yeah.
And, just to be crystal clear to you listening, we're strictly neutrally reporting what the institutional research is saying here, taking no political sides at all. We're just looking at the math.
Of course. But from a purely market mechanics perspective, this environment perfectly explains the severe anxiety underneath the surface of this market. Investors feel compelled to finance a massive wealth transfer into an unproven technology, driven by the assumption of a future bailout if things go wrong.
Which makes our next piece of macro research feel almost completely contradictory. I mean, if tech is facing this massive unproven capex cliff and the underlying market is heavily distorted by bailout assumptions, how is there a highly publicized institutional call for the S&P to hit 9,000 by the end of this year? We're at 7,400 right now. Hitting 9,000 in a few months requires an absolutely flawless macroeconomic environment.
Yeah, it really does. So Jay Hatfield's model for S&P 9000 relies on three specific macro drivers aligning perfectly. You need oil, inflation, and bond yields to all play along. And the first domino is the energy market. Oil has plummeted 27% in just 2 weeks, currently trading down around $70 a barrel. And this massive drop was triggered by a 60-day ceasefire deal in the Middle East.
Right. Though, again, looking impartially at the geopolitical notes we're reviewing, they do point out that recent comments from Donald Trump calling the ceasefire a waste of time and threatening renewed strikes near the Strait of Hormuz have injected massive volatility back into the energy models. That kind of geopolitical friction could instantly spike energy prices and reignite inflation fears.
Yeah, the geopolitical overlay is incredibly fragile right now. But the structural supply side is what gives the oil bears their confidence. OPEC is currently projected to hit their maximum production capacity of roughly 32 million barrels a day. The energy models predict this is going to create a massive 4 million barrel per day surplus on the global market.
4 million surplus, wow.
Yeah, and some analysts believe that sheer volume of oversupply will drag the price of oil below $60 a barrel, easily overwhelming any short-term geopolitical noise.
And the mechanics of that are so vital. If oil drops to $60, headline inflation just collapses because energy costs are baked into the price of literally every single good and service in the economy.
Exactly. That energy collapse is the entire foundation for the S&P 9000 call. Hatfield expects this drop in oil to drag the PCE, which is the Fed's preferred inflation metric, firmly below 2%. And if the data proves inflation is dead, he forecasts the Federal Reserve will execute 3 aggressive rate cuts within the next 12 months.
Because lower rates automatically justify higher stock valuations in these institutional models, right? The cost of capital just drops. Hatfield argues that an S&P valuation multiple of 22 to 23 times earnings is structurally justified right now, primarily because the corporate tax rate was permanently lowered to 21%, which inherently boosts corporate profits. So you take a 23x multiple, you combine it with 3 aggressive rate cuts driven by $60 oil, and mathematically the models just spit out S&P 9000.
Right. The math works perfectly in a vacuum, but there is a massive structural roadblock to that theory, and it comes from across the Pacific. The U.S. Treasury market is currently facing an existential crisis regarding Japanese capital flows.
Oh, this is fascinating. This is one of the most underreported macro risks in the market today. Historically, Japan is the world's third largest international investment surplus economy. For decades, they have literally taken their massive surplus cash and bought U.S. Treasury bonds, effectively financing America's debt. But right now, Japan is executing a historic fundamental pivot. They are launching a $2.3 trillion domestic fiscal policy, and they are dedicating over 25% of that specifically to building their own domestic AI and semiconductor infrastructure.
And to fund a $2.3 trillion domestic initiative, Japan has to keep their capital at home. The research highlights that Japan's finance minister is actively pressuring their massive $1.8 trillion government pension fund to stop buying foreign assets like U.S. treasuries and start exclusively buying domestic Japanese assets.
Which leaves the U.S. Treasury in an incredibly precarious position. The U.S. government needs to finance nearly $12 trillion in debt over the next 12 months. That capitalization requirement is more than double what it was just prior to the pandemic. If our biggest historical buyer, Japan, is keeping their money at home to fund their own AI revolution, who's going to buy $12 trillion worth of U.S. debt?
Nobody. Which creates a massive contradiction for the Federal Reserve. The new Fed chair, Kevin Warsh, has built his entire reputation on hawkish posturing. I mean, he wants to shrink the balance sheet, and he eliminated forward guidance entirely because he wants the market to stand on its own 2 feet.
So expecting the S&P to hit 9,000 is like expecting the Fed to thread a needle while on a roller coaster. I mean, how do they cut rates to boost stocks while desperately trying to finance a $12 trillion deficit without Japan's help? The mathematical reality of that capitalization requirement with vanishing foreign demand means Warsh's hawkish posturing is really just theater. The Fed ultimately has no choice. If there aren't enough buyers for the debt, the central bank will be forced to step in and monetize the debt. They will have to literally print money to buy the bonds themselves to prevent a sovereign default.
Right, which forces Warsh to be a dove in hawk's clothing. And this raises an important question for asset allocation. If the Fed is mathematically forced to monetize trillions in sovereign debt because of this geopolitical supply and demand imbalance in the Treasury market, institutional capital has to seek out assets that protect purchasing power.
And the models are projecting that this exact dynamic, this forced monetization of debt, is why assets with hard supply caps, specifically gold and Bitcoin, are expected to surge significantly by Q4 of this year or Q1 of next year. They act as the ultimate systemic hedges against a central bank trapped by its own government's deficit.
So we basically have a market balancing on the edge of a knife. You have the AI capex bubble fears, the terrifying supply gap in the U.S. Treasury market, and the violent technical pullbacks in the semiconductor space.
Right. So if the macroeconomic environment is this fragile and tech valuations are relying on the assumption of Fed interventions and rate cuts, where does an investor actually hide? You have to look for companies completely decoupled from that macro noise, companies whose cash flow relies on physical, daily utility, not future Fed rates. And the prime case study in our research stack for this kind of gritty, real-world execution is Lyft.
Lyft is fascinating here because they are traditionally viewed as a consumer tech underdog to Uber, not an AI infrastructure play. But they are the perfect example of a non-Mag 7 company capturing shifting capital through sheer operational execution. Over the last 12 months, Lyft generated $1.1 billion in actual tangible free cash flow. They just pulled in a $5 billion quarter by executing 1 billion rides this year.
I mean, that is not a speculative server farm hoping for future software subscriptions, right? That is a billion discrete transactions in the physical world. And they are innovating past competitors on the consumer side, too. They recently introduced a field called price lock, completely eliminating the anxiety of surge pricing for commuters and locking in predictable revenue streams.
But the real reason institutional smart money is accumulating Lyft is their logistical approach to the autonomous vehicle or AV revolution. Lyft recognized they just cannot outspend Waymo or Tesla on software R&D. So they aren't trying to build the self-driving AI. Instead, they partnered with Waymo in Nashville to build a hybrid fleet network.
And the research points out a logistical reality about self-driving cars that the market largely ignores. Everyone is obsessed with the software, the algorithms, LiDAR sensors, but an autonomous vehicle cannot clean up spilled coffee in the backseat. A robotaxi cannot manually return the 8,000 cell phones that passengers leave in Lyft cars every single week.
Yeah, It is a massive, gritty fleet management problem. And to solve this, Lyft literally just built an 80,000 square foot facility in Nashville specifically designed to service autonomous fleets. Their core thesis is that self-driving software will eventually become a widely available commodity, but the physical, real-world infrastructure required to charge, clean, maintain, and dispatch a fleet of tens of thousands of robots in a physical city. That is an incredibly high, capital-intensive barrier to entry.
So I have to ask you listening, is this exactly what smart money is looking for when they rotate out of mega cap tech? Finding companies generating actual cash flow today and building the unglamorous physical infrastructure required for tomorrow's AI revolution, rather than just selling the hype. They are building the railroad, while everyone else is still gambling on finding gold.
Exactly.
Okay, let's step back and look at the entire diagnostic landscape we've mapped out today. We started by tracking the massive flow of institutional capital actively rotating out of the Mag 7, using those heavyweights as a source of funds to buy the gritty infrastructure players of the AR7. We identified the precise algorithmic accumulation levels on the charts, specifically the daily 200 SMA for NVIDIA and Broadcom, and the 50 SMA for Micron following their massive 10-year supply deal.
We also navigated the extreme macro contradictions. We mapped how a collapse in oil prices could trigger rate cuts and mathematically justify an S&P 9,000 target, while simultaneously acknowledging the terrifying $12 trillion gap in U.S. Treasury financing caused by Japan's historic pivot inward.
Right. And we grounded all of that high-level theory in the physical reality of companies like Lyft, generating billions in free cash flow by managing the physical bottlenecks of the autonomous revolution.
It's a remarkably complex web of capital flows, but I do want to leave you with one final thought to explore on your own. We spent a lot of time discussing the fear that this $1.2 trillion in AI capex is a massive bubble that will require a moral hazard-inducing bailout from the Federal Reserve. But what if the most bullish analysts are actually right? What if that massive capital expenditure actually delivers the 50 basis points of structural economy-wide productivity growth that the models project?
Oh, wow. If AI genuinely makes every sector of the global economy 50% more efficient, from supply chain logistics to medical research, does the market even need a Fed bailout down the line? Or will the sheer unstoppable force of technological efficiency simply allow the global economy to organically outgrow its own massive debt burden?
Yeah, it fundamentally changes how you view the risk profile of the entire market.
Diagnosing this market is exactly like looking at a broken X-ray. The picture is muddy, the technical shadows are confusing, and the immediate risks from the treasury market to geopolitical shocks are very real. But the deeper you look into those muddy waters and the closer you track the actual flow of institutional capital, the more the resilient, highly productive bones of this new economy reveal themselves. Thank you for joining us for this deep dive. Keep your eyes on those charts, watch those key historical moving averages, and we will see you next time.